In this chapter, we're going to review some topics about products and investments in general. So we're not going to spend a lot of time in discussion. A majority of this should be review from either previous classes or just common sense, things that you've been able to gather through time. We want to talk a little bit about fixed income instruments. I mean, what are the types? Of course, there are savings accounts, certificates of deposit at banks. There are marketable government issues, treasury bills, treasury notes and bonds, agency notes. Again, a variety of government supplied issues. Non-government types or non-marketable government issues are the typical savings bonds that we taught that Grandma and Grandpa got you for Christmas or for your birthday. So these issues are, as we go through here, I'm recognizing that they're a little bit too hard to read. Series ch and Series I bonds are the things that Grandma and Grandpa got you for Christmas. Treasury inflation protected securities have the added benefit of being not impacted by whatever inflation is. So in times of high inflation, these bonds do not lose their purchasing power. Municipal bonds are offered by state and local governments, not the national or the federal government. So we have revenue bonds, general obligation bonds. Again, these are bonds that are issued to do the business of states and localities. Locally, when you hear about school districts have a levy issue, essentially what they're doing is they are creating a bond issue. It's a general obligation bond. The interest is obviously paid by the taxes of the people within that locality. Corporate bonds, there's a whole variety of corporate bonds. Debentures are the most popular. They are unsecured debt. That is, they don't have any collateral that backs them up. But we also have other bonds that are very popular. Mortgage bonds are obviously used to buy real estate. Convertible bonds are bonds that are have the ability to be converted into common stock. So you can change your investment in a company from a creditor position to an owner position. Callable bonds are bonds that enable corporations to refinance their debt. So they can call back the debt, that is, have you force you to sell the debt back to them, and then from that point you will be issued other debt. The difference is the debt will be lower in interest. Of course, we also have there are junk bonds. That's really a designation. Things aren't issued as a junk bond. It has to do with their bond ratings. They're a very low bond rating. They have high risk. Warrants and rights or other kinds of fixed income securities. Essentially, they give you the right to purchase a certain number of common stocks within a certain period of time. Now, they're included here under fixed income securities because they have a very short lifespan usually, and if there is any interest, it is attached to a bond. The bond ratings, of course, I'm sure everybody is familiar with bond ratings from AAA on down, AAA being the least risky. Generally speaking, they will have the highest prices of a series of bonds, but they reflect the default risk for the debt of a company. I don't like to talk a lot about preferred stock. Preferred stock isn't actually issued all that often. Most financial analysts consider preferred stock a debt instrument, so they incorporate it in their analysis of long-term debt. But we have a variety of stocks. We have convertible preferred stock, callable preferred stock. Cumulative just means that if a company decides not to pay preferred stock dividends, they cannot offer common stock dividends. And what cumulative means is that until they pay back all of the preferred dividends that were due, including those that were passed over, they can't issue any more common stock. So that's really one of the better kinds of preferred stock from a safety point for an investor to want to purchase. Of course, we all know about common stock. There are a variety of descriptions of different segments of the market. Blue chip being the biggest, best. Non-blue chip meaning not blue chip. Growth company stocks, value stocks. We can identify stocks by how big the company is. Very large companies down to micro and nano cap stocks. Very, very small but publicly traded companies. We'll have unlisted and penny stocks at the bottom. Essentially, they're stocks that are very, very cheap. Obviously, very, very risky as well. Unlisted stocks are sometimes referred to as pink listed stocks because they just don't trade very often. So they're not incorporated. They're not part of the common stock marketplace, if you will. Talk a little bit about mutual fund basics. A mutual fund is a corporation that uses its capital to buy investment vehicles instead of plant and equipment. Who are the people that are most suitable for mutual funds? Essentially, someone is looking for the best possible return while trying to minimize risk. But quite frankly, the people who have limited amounts of money, middle-income Americans, fit this pattern perfectly. They just don't have enough money to adequately diversify their risks buying stocks and bonds on their own. So how do you buy money? How do you make money with mutual funds? You do it through the dividends or interest from the investments that are within the portfolio. Now also, the company is managing your portfolio. So that means they are buying and selling assets within the portfolio itself. And of course, those are either sold at a capital gain or a capital loss. So again, that's another way that you ultimately made money. Those first two ways are distributed to the owners of mutual funds through possibly through cash distributions, or they are reinvested for you. In addition, the actual shares of the portfolio itself can grow in value. So we can see that the shares can grow, but also the items inside make money as well. Mutual funds are typically referred to as being either open-end or closed-end. Open-end stocks create more shares every time an investor wants one. So they create new shares. Closed ends have a set number of shares and they actually trade on a stock exchange. So ETFs funds, exchange traded funds, are an example of closed-end funds. What are the advantages of investing in a mutual fund? Well, we have diversification, right? Mutual funds are going to have many different investments. We'll talk about why that's true here in a few moments. But essentially, they're going to have maybe 20 to 40, at least 20 to 40 investments in their portfolio so that you get an adequate diversification. You also get somebody that can manage your money professionally, somebody that knows what they're doing. Now, obviously, this is not free. You have to pay for this management, but you pay for having an account with a stock company as well. So they're going to charge you, so a mutual fund charges you. Liquidity, of course, is one of the most important questions. How soon can I get my money? Well, by law, liquidity is assured. Mutual funds have to distribute the funds within 7 days of their request. Mutual funds, just like stocks, have a variety of choices, a variety of descriptors, if you will. I think it's kind of important to talk about international versus global. International funds should only have investments from outside of the United States, but global funds could include U.S. investments. So if you're looking for maximum diversification, you wouldn't want to use a global fund because that adds more U.S. stocks to an already U.S. or domestic portfolio. International will give you more diversification since it will not incorporate stocks within the United States. And of course, as you read through the book, you'll see what all these different kinds of sectors are. The index funds, we'll talk about those specifically a little bit later. What is a load? A load is a commission. Essentially, there's three ways you pay a commission when you buy mutual funds. You either pay up front, which is called a front-end fund. You pay to redeem, or you pay to sell your stocks back to the company. That's called a redemption fund. Or you have something called a contingent deferred sales charge. This is where you will pay a decreasing commission depending on when you sell the mutual fund. So if you sell it within 1 year, there's a certain commission. If you held on to everything and you sold it in 2 years, the commission that you sell would be less. And eventually, if you hold it long enough, I think the average time frame is 7 or 8 years. After that, there's no commission. So, truly a contingent deferred sales charge, if you're going to hold something for 8 years or more, is essentially a no-load kind of a fund. You don't pay any commission to buy it. However, that doesn't mean there aren't any fees and expenses. There are always fees and expenses with owning an investment. There's management fees and operating expenses. Within a mutual fund, these will be fairly similar across the board for almost all funds. The exception might be for index funds, which will have very low operating expenses, and international funds, which will have very high operating expenses. But in general, these fees are going to be very similar, very closely related across a mutual fund family. 12B1 fees are fees that are paid essentially as an advertising cost. It's a very low amount, usually about 0.25 or so. So it's a very low amount, but they're called 12B1 fees. If the fund is actually owned by a trustee, there may be trustee fees that have to be paid. There is an important ratio that we can look at. It's called the expense ratio. And it's a ratio of expenses to the net asset value or the value of the share. The higher the ratio, the better the company has to perform to generate the right kind of return. So this is a great characteristic to explore when you're trying to choose between mutual funds. You want the one that's going to produce the greatest amount of net revenue to the company or to you. Again, a mutual fund is a corporation, has authorized shares. They're initially sold in the primary market, and after the initial sale, a secondary market transaction happens. A mutual fund, though, is different. Shares are redeemed, right? They're sold in the primary market, but they are redeemed by the mutual fund. So they are brought back to the mutual fund, and then they are retired. They're never used again. So the shares of stock that you buy from an open-end mutual fund, you buy from the company, and then you redeem them or issue them back to the company, and then they are destroyed. Those code numbers are then destroyed. There are two people to be concerned about in a mutual fund: an investment advisor and the custodian. The investment advisor is the money manager. They deal with the day-to-day investment decisions. The custodian is the bookkeeper. They are in charge of safekeeping the cash and the securities that are purchased. So these are the primary individuals that run and manage a mutual fund. So how do you ultimately choose mutual funds? And this really isn't a very